All right, this Friday Fox Business Alert, mortgage rates hovering near lows. Good news for housing, but the bad news is what is going up right now. They might not be that low for long because bond yields keep rising up. And Dani Babb says, now if this kind of thing keeps up, well, the housing market will stay down and maybe go further down. The real estate guru joining me right now. Good to see you in the flesh. Haven't seen you in a while.
It's been a while.
So what's going on here?
Okay, so as bond yields go up, that in lockstep happens with 30-year mortgage fixed rates. And so if that continues to play out, what we're going to see is less demand in the 30-year fixed rate territory. Right now, and if you look back at 2006, we only had about 40% of mortgages were in the fixed rate territory, fixed rate type. Right now, it's 91.
The rest were adjustable.
We're adjustable, right, which is tied to the LIBOR, something entirely different and
London
more controlled.
Interbank Offered Rate.
Exactly,
Right?
and more controlled by the Fed. In today's market, 91% of mortgages are actually fixed rates, which is directly tied to the bond yield. So it is a concern, particularly the 10-year bond yield, because even though a note is 30 years, a mortgage interest note, most likely they're going to be sold within 10 years, so that's when investors look to as the number.
And that's the one that they're increasingly pegged to. But still, you're very young, but I can remember a time where interest rates like these were what, my wife and I paid, I think, per day with our first mortgage. So, I mean, we've been sort of spoiled with these sub 6% fixed rate mortgages for quite a while, 5%. That can't continue anyway, right?
It can't continue. Adjustables are in the 3% range. But Americans have lost $6 trillion in mortgage, in home equity
so they don't
since
need another excuse not to buy.
So they don't need, exactly, they don't need another excuse not to buy. We have enough of them. People are really worried about jobs, are worried about the fact that we've lost 36% of home values in the last couple of years.
And you see more of that coming, right?
I do. I see more of it coming. I think that people are insecure about the markets. They have good reason to be. And we have no idea what type of assets are on the books and what the foreclosure outlook is going to look like long term. It could be far worse than we've seen.
Could you educate me on this? I hear about a new wave of foreclosures that could happen because there's been a backup, like planes at LaGuardia, of these applications. Once that opens up again, all the new ones come on, right?
Yeah.
And then we could have a new downdraft.
We could. We have had moratoriums that have been state-driven. We've also had legislation that has caused banks to have to go back and show this piece of paper is owned by all of these people, and all of them need to come to the table, show ownership, and then foreclose. So right now, the nationwide average is 500 days.
So everyone has to agree to it.
And they have to know who owns it. Right now, it takes 500 days in this country to foreclose on a home on average, 800 days in Florida and New York. How the heck is anyone supposed to know how big of a mess we have when we don't even know how many homes are in the backlog?
So what you're saying, the whole foreclosure thing continues, picks up steam.
Picks up steam.
In an environment where interest rates, at the very least, nominally back up. And in a job environment that hasn't measurably improved. That's not good.
It's not good. And if we look at the only other time in history where this much value has been lost in real estate was right during and after the Great Depression. It took 19 years to recover. If we look at the beginning of the housing crisis in 2006, that puts us at 2025 before we have a housing recovery. Obviously,
2025?
Obviously, the job conditions were much worse during the Great Depression, but we have different issues facing us now that we have not seen in the past, and we don't know how those are going to ultimately play out in the market.
Well, my home is now worth a rundown Stuckey's drive-through. So, are you saying that in those markets where prices have been cut in half or 30–40% off their highs, I'm talking Florida, the West Coast, the Northeast, the Boston, New York corridor, that there's more to come, even with those huge hits already? Even
with the huge hits already, particularly in the high-end homes like you're talking about. If we look at anything in the jumbo market's been the last one. The banks don't want to own that stuff. The government doesn't want to own that stuff. Fannie and Freddie, they don't even want those toxic assets back. They've already bought $200 billion and they don't want more. The jumbo market is the next big one to fall, and the jumbos have yet to reset. That'll happen in the next 1 to 3 years. When that happens, we'll have yet another tumble in the high-end housing, I believe.
What could knock all of this dour stuff off the equation? In other words, I always think, and you and I have chatted about this before, jobs is the great purifier. You start seeing more jobs, it builds more confidence, people buy homes, blah, blah, blah. No?
Yeah, but as that happens, also home builders build more homes and we get more inventory, and that can dilute prices. What's going to stop this? I have no idea. My view is the government needs to stay out, allow the moratoriums to be lifted in every state, let the foreclosures work through the system, allow the banks to do short sales, stop penalizing lenders that didn't meet government guidelines for how many people got modifications, and get the government out of the intervention process.
That's a brilliant point. Quit punishing the guys that's a very good point. Dani, great seeing you. Have a great weekend.
You too.
All right, Dani Babb.
All right.